This is a critical week for world central banks. A slew of reserve banks set to release rate decisions this week. To discuss what moves we might see, we want to bring in Greg Dacko. He's EY chief economist. Greg, it's great to have you here. So let's talk about what the decisions that we're expected to get, not only here from the Fed, but also Bank of England. When you take a look at Bank of Japan, ultimately what that would signal then about the health of the global economy.
Yeah, it's a busy week for central banks for sure. We have the Fed, we have the Bank of England, we have the Bank of Japan. Last week we had the European Central Bank easing monetary policy. I think this week we're going to see the Fed ease monetary policy. The key question, of course, is 25 basis points or 50 basis points. We're likely to have the Bank of England on hold, and we'll have the Bank of Japan likely signaling or tightening monetary policy. So diverging directions there. I think broadly speaking, in terms of the global economy, what we're seeing is an environment where the global economy is doing relatively okay, but we are seeing signs of slowdown in the US, which has been the main engine of global economic activity, the outperformer in 2023, the outperformer in early 2024, while Europe, the UK are struggling in terms of growth momentum.
So let's talk about the U.S. then, because I know that you're anticipating 25 basis points this week. Do you think that opens them up to a 50 basis point cut the next time that they meet? Is that one of the drivers behind your call?
I think the key question right now is where they'll end up over the course of the next few months. There's a lot of debate as to whether they go 25 or 50 basis points. Our call last week was 25 basis points. We're not going to change that so close to the meeting, but there were a couple of recent articles in the Wall Street Journal and the Financial Times that raised the uncertainty as to the potential for 50 basis points. We continue to think that the Fed is extremely data point dependent and that gradualism is likely to be the favored approach for a lot of policymakers. But Fed Chair Powell has shown openness to front-loading rate cuts. And if he manages to convince the rest of policymakers that a faster start to the easing cycle is necessary and useful for the economy, then that will be the trajectory.
Is that a strategy that makes sense at this point?
I think so. I think front-loading makes sense because the Fed is, in our opinion, behind the curve. I've been saying for a while now that the Fed should have started easing monetary policy back in June, in July perhaps, but now we're in September and we're late in the game.
So then, Greg, then what is the risk? I guess if you could outline it maybe a bit more plainly here. If the market only goes 25, what does that then risk look like here for the economy down the line if the Fed is in fact late to act?
That's a great question because a lot of people are saying, well, 25 basis points doesn't really matter. And it's true, right? If you ease monetary policy by 25 basis points, it does little to nothing in terms of consumer rates, auto loan rates, mortgage rates, very little. But the risks are asymmetric. If the Fed does not ease monetary policy by as much as market are anticipating, then you'll actually see a repricing of rates and you're going to see upward movement in terms of rates. And that could damage consumer spending activity, housing activity, business investment. That is the real risk right now. And that is why the Fed's extreme data point dependency is a risk for the economy. It breeds volatility and it leads to these sudden repricings in market that are deterring economic activity. That's the real risk right now, is that the Fed does not do what the markets are anticipating, and that's a lack of communication and a lack of robust framework on the part of the Fed that is leading to this.